Imagine handing the South African Revenue Service like over R1 million in donations tax.
Oh, man.
And not because you generously gave a fortune away to charity,
Yeah.
right? But simply because you didn't charge your own family interest on a loan.
It sounds completely backward, doesn't it?
It really does. But that is an actual trap that's just swallowing South African entrepreneurs every single day. So welcome to this deep dive.
Glad to be here for this one. It's so important.
Yeah, because if you've spent years grinding to build a business, accumulating assets and creating a life for your family, well, today is about making sure a single lawsuit or a routine tax audit doesn't just wipe it all out.
Right. It is the ultimate entrepreneur's nightmare, isn't it? I mean, you spend decades building this incredible financial engine. The revenue is there, the assets are there, but because of how the foundation is structured, a single point of failure can just bring the entire thing crashing down.
Exactly. And that is exactly what we are pulling apart today. We are looking at a really comprehensive tax guide called South African Trust Tax Pitfalls and Compliance Strategies.
A bit of a mouthful, but a great guide.
Yeah, heavy title, but incredible data. And we are pairing the hard data in that guide with the practical, on-the-ground insights of Lunka Sturman. She is a specialist trust consultant.
And her insights are just gold for this.
Totally. So the mission today is to uncover the immense positive power of trusts. We're going to explore how they act as an ultimate shield for your wealth, how to navigate this incredibly complex cat and mouse game with the taxman, and how exactly you can build a legally compliant asset protection fortress.
I love that term, asset protection fortress.
Right. So, okay, let's unpack this. Before we even touch the tax codes, we have to look at the fundamental why. Like, why go through the administrative hassle of setting up a trust at all?
Well, to understand the why, you really have to look at the sheer danger of the default setup that most people use. I mean, most entrepreneurs start out just hustling.
Yeah, survival mode.
It's exactly, survival and growth. They aren't thinking about legal structure. So they put absolutely everything in their personal names. The trading company that is out there taking risks, signing leases, employing people, that company is often directly linked to their personal wealth. They sign personal sureties for business loans. It just becomes this massive, tangled web of mixed personal and business liability.
Right. So if you're listening to this and your business equipment, your commercial property, and your family home are all basically swimming in the same legal pool, you have a problem.
A massive problem. Because if the business takes a hit, say, a supplier sues you, or a major client goes bankrupt and you default on a loan, those creditors can pierce right through to your personal assets. They can take the house.
Wow. And that's where Lunka Sturman's core philosophy cuts right through that mess. She operates on a principle that is, well, it's simple but legally profound. She says, your trust owns the assets. Your company carries the risk.
Yes. That division is everything.
It makes total sense. Actually, thinking about it in a modern context, it's kind of like building a massive commercial ship.
Right.
The operating company, the business you run every day, that's the outer hull of the ship.
Okay, I like where this is going.
Yeah, so it's out there navigating the ocean, smashing into the ice, weathering the storms. It takes all the hits. But the trust is the system of watertight compartments deep inside the center of the ship.
Right.
You keep the precious cargo, the engines, in those inner compartments. So even if the outer hull gets breached by a rogue wave, like a lawsuit or a bad market turn, the watertight compartments hold. The ship doesn't sink.
That is a much better way to visualize it than the old dusty legal textbook examples, honestly. And the actual legal mechanism that makes those watertight compartments work is called separation of control.
Separation of control. Let's break that down.
So when you place an asset into a trust, you, in your personal capacity, legally alienate yourself from that asset. You literally don't own it anymore.
Well, you don't own it?
Nope. The trust is a separate legal person. It's managed by trustees for the benefit of the beneficiaries.
So if a creditor comes after me personally or tries to liquidate my operating company, they hit a brick wall.
Exactly. Because you literally cannot give them the house or the investment portfolio. It is not yours to give.
That's incredible.
And we need to be really clear here. This isn't some shady back alley loophole. This separation of ownership from risk is exactly how ultra-wealthy families have protected and grown their estates across multiple generations.
Yeah, it's the standard playbook.
It is. And what is so empowering about this source material is the realization that small and medium business owners can, and absolutely should, use these exact same principles. It ensures business continuity.
Because if something happens to the founder, right.
Exactly. If something happens to you, the assets aren't tied up in some messy deceased estate that takes years to wind up. They are already safely housed in the trust.
Okay, so you've perfectly insulated your assets from business creditors using these watertight compartments. The wealth is secure. But here is where it gets really interesting.
The taxman.
The taxman. The irony is that by moving that wealth to safety, you've just stepped right into the crosshairs of SARS.
You really have. This is the ultimate cat and mouse game. The South African Revenue Service, SARS, they know exactly how powerful trusts are, and they have spent decades building this incredibly complex web of anti-avoidance rules.
Just to make sure people aren't using them to unfairly dodge taxes.
Exactly. And this brings us specifically to Section 7 and Section 7C of the Income Tax Act.
The trapdoors.
The trapdoors.
Let's start with Section 7, subsection 2, because this one specifically targets parents who are, well, using their kids as tax shields.
That is exactly what it does.
Yeah.
SARS looked at the landscape and saw this recurring pattern. High-earning parents, who are usually sitting in that maximum 45% marginal tax bracket, would funnel income-producing assets into a trust. Then, the trust would earn money, say rental income or dividends, and the trustees would distribute that income to the minor children.
Because a 5-year-old doesn't earn a salary, so their personal tax rate is basically zero. It's a free pass.
Right. And SARS said, hold on a second. A minor child cannot meaningfully decide how to spend 100,000 Rand. The parents are obviously still pulling the strings.
Yeah, they're just legally routing the money through the child's name to avoid paying their 45%.
Precisely. So Section 7, subsection 2 was created to attribute that income right back to the parent who donated the asset in the first place.
The tax guide gives a really sobering breakdown of this with the Botha family. So Mr. Botha settled 5 million Rand into a family trust. The trust earned 400,000 in dividends and interest.
So far, the ship is sailing smoothly.
Right, perfectly smooth. The trustees then decided to distribute 100,000 Rand to each of his 4 kids. 2 of them were adults, but 2 of them were minors under 18.
And let's look at the mechanics of what happened next, because it's brutal.
Yeah, for the 2 adult kids, it worked perfectly. They received the money, and because they are adults, SARS taxes them at their own individual lower rates.
Which is legal and fine.
But for the 2 minor children, that combined 200,000 Rand distribution triggered Section 7, subsection 2 immediately. SARS just ignored the kids, attributed the 200,000 directly back to Mr. Botha, applied his 45% marginal rate, and slapped him with an unexpected 90,000 Rand tax bill.
Wow. And what's fascinating here is that it's a completely unforced error.
Totally unforced.
He defeated the entire tax efficiency of his own trust simply by distributing the money to the wrong beneficiaries at the wrong time. If he had just retained that specific income in the trust or only distributed it to the adult children, he wouldn't have triggered the attribution rule.
Man, so that's the trap of who you give the money to. But the cat and mouse game evolved, didn't it? Because then SARS introduced Section 7C.
Oh, 7C.
Yeah, and this one isn't about the income at all. It's about how the wealth gets into the trust in the first place. The low-interest loan trap.
This is a major one, and it catches so many business owners off guard. Because before 2017, a brilliant and completely legal strategy was to move your wealth into a trust by selling your assets to it.
Right.
But since a new trust usually doesn't have any cash sitting around, you, the founder, would give the trust an interest-free loan to pay for the assets.
Makes total sense.
It did. Because it was a loan and legally had to be repaid eventually, it wasn't classified as a donation. Therefore, you completely avoided paying the 20% donations tax.
Yeah.
You basically got the assets into the watertight compartment for free.
But then SARS closed the gap.
They slam it shut.
Our source details how Section 7C works now. Basically, if you give a trust a loan with an interest rate below the official rate, which is currently sitting at 7.75%, SARS views that foregone interest as a deemed annual donation.
Yes, and the Prinsloo family from the case study got absolutely hammered by this.
They really did. They sold a 15 million Rand portfolio to their trust on an interest-free loan. And because they didn't charge that 7.75%, SARS calculated a deemed donation of over 1.1 million Rand every single year.
Just invisible money they were being taxed on.
Exactly. After their basic exemptions, they were paying over 212,000 Rand in donations tax annually. Over 5 years, that mistake bled over 1 million Rand in tax from the family.
It's just a staggering loss of capital.
Okay, wait, I have to push back here. I really struggle with the logic of this one.
Go for it.
If it's my money, right, that I earned going into my family's trust to benefit my family, why on earth can I just give them a free loan? It feels like I'm just moving money from my left pocket to my right pocket. Why does SARS get to step in and demand 20% of invisible interest?
It's a very common frustration. I hear it all the time. But to understand it, we have to look at the underlying mechanics of finance. If we connect this to the bigger picture, SARS does not view the trust as your right pocket.
Because of the legal definition.
Exactly. Remember our legal definition. The trust is a completely separate legal person.
Right, the watertight compartment.
Right. Now, in the commercial world, money has a time value. Money costs money. If you walked into a bank tomorrow and asked for a 15 million rand loan, they would charge you a massive amount of interest for the privilege of holding their capital.
For sure.
So by giving this separate legal entity, the trust, 15 million rand and not charging them a cent of interest, you are effectively giving them the massive earning potential of that money for free.
Ah, okay, I see.
You are gratuitously enriching the trust at the expense of your own personal estate. And in the eyes of the taxman, gratuitous enrichment is the exact definition of a donation.
Okay, that makes sense.
SARS is basically saying you should be earning 7.75% on that money. Since you are choosing not to, you are donating that 7.75% value to the trust every single year, and we are going to tax you on it.
Okay.
Logic tracks. But a 1 million rand tax bill for trying to protect your family's assets feels incredibly punitive. So how do you actually survive this? Well, there is a way.
If you are forced to charge interest, but the trust doesn't have the cash flow to actually pay you that interest every month, what do? Do you just write an IOU?
You're actually very close. Here is the positive solution, and it's why understanding the mechanics of these rules is just so empowering. You can completely neutralize this trap if you understand balance sheets, which is exactly what the Ferreira family did in our source material.
Okay, break down the Ferreira strategy for us. How did they fix the balance sheet?
So the Ferreiras also had a massive loan to their trust. But instead of ignoring Section 7C and just hoping SARS wouldn't notice, they proactively charged the trust the 7.75% interest. They documented it formally with a trustee resolution.
Okay, playing by the rules.
Exactly. Now, as you pointed out, the trust didn't have the physical cash in its bank account to pay that interest to Mr. Ferreira, so they capitalized it.
Capitalized. Let's unpack capitalized. What does that physically mean on the paperwork?
It means they added the interest amount to the total outstanding loan balance.
Yeah.
So let's say the loan was 10 million rand and the interest for the year was 775,000 rand. The trust now owes Mr. Ferreira 10,775,000.
Ah, I see.
It's just an accounting entry.
Right.
No physical cash moved between bank accounts, but legally, the interest was charged and added to the debt. SARS is happy because the rule was followed.
Okay, but now the trust just owes him more money. How does that actually help?
Here is the brilliant part. Every individual taxpayer in South Africa is granted an annual donations tax exemption of 100,000 rand.
Okay.
If you are married, spouses together have 200,000 rand. So on the last day of the tax year, Mr. and Mrs. Ferreira formally drafted another document. They waived, or legally forgave, 200,000 rand of that capitalized interest debt.
Oh, wow. Okay. So they charged the interest to satisfy the law, added it to the loan, and then immediately used their legal tax exemptions to chip away at that exact same debt.
Precisely. They engineered the balance sheet. By meticulously documenting the capitalized interest and the subsequent waiver, they paid absolute zero in donations tax.
That is brilliant.
The trap is completely avoidable, but you have to know the rules of the game to play it effectively.
So if you are listening to this right now and you currently have a massive loan account to your trust, you need to call your accountant tomorrow. You need to check if they are capitalizing that interest and utilizing your 100,000 rand exemption.
Absolutely. Because if they aren't, you are bleeding capital. It is a critical compliance check.
Man. So we've talked about getting the money into the trust safely, but what happens once the money is inside? Because there's a major myth out there, and I hear this all the time from entrepreneurs, that just putting your money into a trust automatically lowers your tax rate.
Oh yeah, the myth that the trust itself is a tax haven. That is perhaps the most dangerous myth of all. If we look at the actual numbers, the reality is the exact opposite. If a trust retains its income, meaning it earns a profit but doesn't pay it out to any beneficiaries, it is taxed at a flat rate of 45% from the very first rand.
Wait, from Rand 1, there's no sliding scale like with personal income tax.
None at all. There are no lower tax brackets. It is the absolute highest marginal rate immediately, and the capital gains tax, or CGT, is equally brutal.
Let's do the math on that.
Let's do it. If you, in your personal capacity, sell a property and make a 1 million rand profit, your maximum effective CGT rate is 18%. So you owe SARS 180,000 rand.
Okay, 18%, not terrible.
Right. But if your trust sells that exact same property and makes the same 1 million rand profit, the effective CGT rate for a trust is 36%. It owes SARS 360,000 rand. It is literally double the tax.
Double the tax. Wow, so if a trust is taxed so aggressively, why use one to hold income-producing assets at all? I mean, if I want to grow my wealth, a 45% headwind and double capital gains tax sounds like a terrible strategy.
And this brings us to one of the most powerful and elegant mechanisms in South African trust law, the conduit principle.
The conduit principle.
Yes. The mistake people make is viewing a trust as a bucket. They think the goal is to pour water into the bucket and just leave it there. But a trust is legally designed to be a pipe that the water flows through.
A conduit.
Exactly, a conduit. Here is how the legal mechanism of the conduit principle works. If the trust earns income, but the trustees elect to distribute that income to a beneficiary within the exact same tax year, a legal concept called vesting occurs.
Vesting, okay.
The trust doesn't pay the tax, the income flows through the conduit, and it lands in the hands of the beneficiary.
And then it gets taxed at the beneficiary's rate.
Yes. The magic is that it is taxed at the beneficiary's personal tax sliding scale, which is almost always significantly lower than that flat 45%.
Oh, that's huge.
Furthermore, the income retains its original character as it flows through the pipe. So if it was rental income in the trust, it vests as rental income for the beneficiary. If it was a dividend, it remains a dividend, and they get all the associated exemptions.
The source gives a fantastic real-world example of this with the Van Zyl family. So the Van Zyl Trust earned 1.2 million rand a year in profit.
It's a very healthy trust.
Very healthy. But initially, they treated it like a bucket. They just left it in the trust to grow, paying that 45% flat rate, which meant they were sending 540,000 rand straight to SARS every single year.
Which is just incredibly inefficient capital allocation.
Highly inefficient. So they analyzed their family structure and saw they had 3 adult beneficiaries who were in much lower tax brackets. Maybe they were, at university or starting entry-level jobs.
Right.
They started utilizing the conduit principle, flowing 400,000 rand through the pipe to each of the 3 adults. Because of the sliding scales, the combined tax those 3 individuals paid was only 300,000 rand.
Amazing.
By just flowing the money through the pipe instead of leaving it in the bucket, they saved 240,000 rand a year. Over 10 years, that is 2.4 million rand in wealth kept inside the family, simply by understanding distribution mechanics.
It's a profound difference. But, and we cannot stress this enough, none of this works without a meticulous, rock-solid paper trail.
Yeah, the paperwork.
You cannot just decide in your head that the money flowed through the conduit. You cannot tell an auditor, oh yeah, that was for my daughter. You have to prove it legally.
Right, because if you don't have the proof, SARS just assumes it stayed in the bucket and hits you with the 45%. So essentially, a trust is this brilliant tool, but it's like a high-performance sports car. If you don't keep a meticulous logbook, SARS is going to impound it.
I love that analogy. And what's fascinating here is that when business owners face massive penalties from SARS, it is rarely because they did something malicious or tried to evade tax like a criminal.
Right, they aren't money launderers.
Exactly. It is almost always simply because they couldn't prove they did it right. If you want to claim the conduit principle, the legal requirement is that you must have written, signed trustee resolutions dated before the end of the tax year, proving that the income was formally vested in the beneficiary.
The Musa family case study perfectly illustrates the danger here. They had a trust for years, but they were making decisions informally around the dinner table.
Oh, the classic dinner table resolutions.
Yep. No written resolutions, no documented Section 7C interest capitalization. They were basically treating the trust like a casual family bank account.
Which is a ticking time bomb for an audit, because an undocumented trust is an invalid trust in the eyes of the law.
But they caught it in time. They brought in an advisor, implemented a full remediation program, drafted the outstanding resolutions for past years, formally calculated and recorded the interest. They built the logbook.
And thank goodness they did.
Yeah, because when SARS finally did audit them years later, the audit concluded with zero adjustments. They passed with flying colors because their paperwork was bulletproof.
The paper trail is the actual armor of your watertight compartments. Without the resolutions and the balance sheet entries, the steel walls are just an illusion.
Which brings us to a really crucial point. We've seen the incredible wealth-saving potential, like the Van Zulls saving millions through the conduit, and we've seen the disastrous financial traps, like the Prince Louis paying over $1 million in unnecessary tax just because of a loan.
Right.
It is abundantly clear that a DIY approach to trusts is just financial suicide. So, how does a business owner actually implement this safely without needing a law degree?
Well, this is exactly where the philosophy of someone like trust consultant Lumka Stearman becomes invaluable. What I find really compelling about her approach is that she isn't just selling off-the-shelf trust deeds.
Yeah, she's not just a document factory.
Exactly. She acts as an architect for your specific situation. Her mission is to empower South African small business owners through education and personalized structural design.
Yes, looking at her methodology, she actually translates all this dense, terrifying jargon into practical business steps. Like, instead of just saying you need a trust, she starts with what she calls a foundation audit.
Which is exactly the right place to start. A foundation audit is essentially a stress test of your current setup. She analyzes your personal exposure versus your business risk and assesses if you are actually generating enough assets to warrant a trust structure yet.
Right, it's about auditing the whole of your ship before you start building the compartments.
Precisely.
And for someone who is ready to build, she moves them to an asset protection blueprint session. This is where she maps out the separation of control. She customizes the flow of assets to ensure you don't trip those Section 7 landmines, and she structures the balance sheet so you can safely utilize things like the annual donations exemptions.
It's so comprehensive.
It really is. So if you are listening to this and you know your foundation is shaky, you can see exactly how she breaks this down on her site. It's www.lumcasterman.com. You can join her exclusive asset protection waitlist right there.
And it is so important to view the cost of that kind of strategic architecture in the proper context. I mean, SARS understatement penalties can range anywhere from 10% to 200% of the tax owed, plus compounding interest.
Ouch.
Yeah. So paying an expert to design your fortress correctly from day one is just a fraction of the cost of getting it wrong and facing an audit empty-handed.
It really is the best insurance policy you could possibly buy for your life's work. And setting it up is only step one, right? Because as we saw with the Musa family, maintaining the logbook is just as important.
Oh, definitely.
Lumka's model actually includes an annual fortress review, which ensures your trustee resolutions are signed, your Section 7C interest is capitalized, and you are adapting to any new moves SARS makes in the cat and mouse game. Because the tax laws don't sit still, so your strategy shouldn't either.
Precisely. To synthesize everything we've covered today, trusts are absolutely not just tools for the ultra-wealthy elite. If you are a South African business owner, a consultant, or an entrepreneur generating income and building assets, a trust is an essential, legally compliant tool.
It's mandatory for real protection.
It is. It requires administrative discipline, yes. But that discipline rewards you with isolated liability, incredible tax efficiency when you use the conduit correctly, and the ultimate protection of your capital.
And as we wrap up, there's a really profound idea here that wasn't explicitly broken down in the tax codes or the balance sheets, but it kind of hovers over this entire conversation.
What's that?
Well, setting up a trust forces you to do something most of us actively avoid. It forces you to confront your own mortality. It forces you to look at the legacy you actually want to leave behind.
That is a crucial point. Establishing a trust is not just a defensive move against the taxman. It is an act of deep care for the next generation.
Exactly. Think about it. If your wealth outlives you by 100 years, what personal values are you encoding into the legal DNA of that trust today? When you separate the risk of the open ocean from the safety of the watertight compartments, you aren't just protecting money. You are ensuring that long after you're gone, the structure you built continues to stand, providing shelter, education, and opportunity for the people you love. So take a look at your own structures, ask the hard questions, and we'll catch you next time.